Something quietly shifted before the headlines caught up. While Washington talked sanctions again, China moved roughly $312 billion into chips, fabs, and supply control, and that timing matters more than speeches. Most people hear sanctions and think pressure. I hear preparation. In my view, China isn't reacting to the U.S., it's adjusting to a future where access, not price, decides who stays relevant. The United States keeps signaling tougher rules on advanced semiconductors, but rules only work if alternatives don't exist, and history shows large systems never wait politely. Over the past 2 years, capital tied to Chinese industrial policy quietly flowed into domestic chip firms, equipment makers, and materials, even as growth headlines looked weak. This looks similar to what Japan did in the 1980s with autos and memory chips, when trade pressure actually accelerated internal coordination rather than slowing it down. In my view, sanctions are being treated less like a wall and more like a countdown clock, and that changes how rational actors deploy money at scale. Public filings show billions directed toward foundries like SMIC, not because they lead today, but because control tomorrow beats efficiency now. Meanwhile, U.S. firms like NVIDIA sit at the center of the debate, caught between profit incentives and national policy priorities that don't always align. What's interesting is that markets barely reacted. Stocks moved, commentators argued, but capital positioning told a calmer, more deliberate story beneath the noise. When systems expect disruption, they don't panic, they rewire. That usually starts with boring line items like tooling, chemicals, and long-term power contracts. China's focus hasn't just been on chips themselves, but on the inputs around them, because choke points rarely sit where headlines point. This mirrors energy markets in the 2000s, when countries didn't just buy oil, they locked shipping, storage, and currency settlement quietly. In my view, the $312 billion figure isn't about winning the chip race, it's about removing existential risk from the system over the next decade. Washington's messaging suggests confidence, but confidence doesn't require constant repetition, and that contrast is worth paying attention to. Historically, when dominant systems talk loudly while rivals build quietly, outcomes tend to surprise people who focused only on policy. None of this means immediate change. Systems move slowly, then suddenly feel different once thresholds are crossed and dependencies fade. The real signal isn't who announces sanctions next, but who can still function when rules change again without asking permission. That's why this shift matters, not as a headline event, but as a structural adjustment that will shape pricing, leverage, and influence later. What this suggests is a world where technological self-reliance becomes a form of monetary policy, even if it's never called that directly. Capital usually moves first, narratives follow later, and right now the money is telling a more patient story than politics. The part most people miss is that markets reacted less to sanctions than to silence. When capital stops reacting emotionally, it usually means decisions were made earlier, behind closed doors. In my view, China's chip spending isn't about catching up technologically. It's about removing dependence, because dependence is the most expensive risk once politics enters supply chains. When United States restricted advanced lithography access, it framed the move as leverage, but leverage only works while the other side needs you tomorrow. Chinese officials never promised leadership in chips this decade, which tells me expectations are set internally, not for headlines or market applause. What's telling is how Chinese banks kept extending long-term credit to semiconductor projects even as property lending collapsed and consumer confidence weakened. That divergence matters. Historically, when credit is rationed everywhere except one sector, that sector is being treated as systemic insurance. Executives at ASML openly admitted demand from China didn't disappear. It simply shifted to older nodes and alternative processes. In my view, that's not a workaround. It's a bridge strategy, buying time while domestic tooling slowly improves under protection. Markets often assume older chips mean less power, but cars, grids, weapons, and factories still run mostly on mature nodes. That's why this story isn't about smartphones or AI hype. It's about industrial continuity when trade rules tighten unexpectedly. The U.S. talks about reshoring with the CHIPS Act, yet timelines stretch into years, while China's spending already hit the ground. Capital timing matters more than press releases. Systems that move money early accept inefficiency now to avoid fragility later. You could see a similar pattern during the Cold War when parallel tech stacks quietly formed under export controls. Back then, duplication looked wasteful. Later, it looked like survival once political lines hardened. In my view, we're watching a modern version of that separation, but this time driven by finance before ideology. Statements from Intel about delays and cost overruns highlight how hard industrial rebuilding actually is, even with subsidies. Meanwhile, China's model tolerates lower returns today because state-backed capital answers to stability, not quarterly earnings calls. That difference changes how risk is priced, and markets still struggle to reflect that asymmetry properly. Investors often ask why Chinese equities lag if all this is happening, but capital strategy and market sentiment rarely align short-term. What matters more is control of process, talent pipelines and materials, not share prices reacting to Western narratives. In my view, the real contest isn't chip performance, but who absorbs shocks better when access gets restricted again. And history suggests systems that prepare quietly tend to surprise those focused on headlines rather than balance sheets. This isn't about who wins next year. It's about who can still function normally when rules tighten without warning. That's why the $312 billion shift feels less like a bet and more like a structural hedge against an uncertain order. Capital doesn't move on ideology, it moves on incentives, memory, and fear of repeating past vulnerabilities. When you watch it through that lens, the chip story stops being about tech and starts being about power. And power, once decentralized, rarely announces itself until it's already changed the game. What makes this phase different is that prices haven't screamed yet. When money moves quietly and assets stay calm, it usually means institutions aren't trading headlines, they're repositioning systems. In my view, the calm around semiconductors is misleading because infrastructure shifts rarely show up in quarterly charts until dependence is already reduced. Look at how commodity markets behave before sanctions hit. Oil, gas, and metals often move months later once logistics and contracts quietly change. China's chip push follows that same logic. The spending isn't chasing margins, it's buying optionality when access becomes conditional or politically negotiated. Executives at TSMC have repeatedly said fabs are about ecosystems, not buildings, and ecosystems take years to reroute. That's why the $312 billion matters less as a number and more as a signal of commitment across cycles, regardless of short-term inefficiency. The U.S. financial system is built on speed and return, which works incredibly well in open markets, but struggles when duplication is required. Historically, when systems are forced to duplicate supply chains, the cheaper system often loses patience first, not the more controlled one. You saw this in rare earths a decade ago, when China restricted exports and prices spiked, then normalized after supply chains fractured permanently. In my view, chips are following that script, but at a much larger scale, with deeper ties to defense, energy grids, and industrial automation. Public comments from U.S. officials frame controls as targeted and temporary, yet businesses plan as if restrictions only expand over time. That mismatch between language and planning is where long-term capital tends to side with caution rather than optimism. Chinese planners seem to assume the worst-case scenario by default, which looks pessimistic until you realize pessimism reduces surprise. Markets prefer optimism because it boosts valuation, but systems prefer redundancy because it preserves continuity. This difference explains why headlines feel dramatic while balance sheets change slowly and deliberately underneath. In my view, the real risk isn't technological lag, it's coordination failure when multiple choke points are activated simultaneously. Semiconductors sit at the intersection of software, energy, logistics, and security, which makes them uniquely sensitive to political friction. When one node becomes unreliable, entire downstream systems reprice their assumptions, even if consumers never notice immediately. You can already see governments talking about trusted supply, a phrase that didn't matter a decade ago, but now drives procurement rules. That shift alone changes who gets contracts, who scales, and who quietly exits strategic relevance. Capital understands this faster than voters or markets because capital is punished first when access disappears. In my view, this is why China's move feels defensive rather than aggressive, despite how it's framed externally. Defensive systems tend to be patient. They spend early, accept inefficiency, and wait for conditions to tighten. Aggressive systems often rely on leverage and timing, which works until the environment changes faster than policy can adapt. None of this guarantees outcomes. History shows parallel systems can coexist uneasily for years before one becomes dominant. What matters is that once parallel structures exist, leverage declines and influence becomes harder to enforce. That's when power shifts from rulemaking to resilience, a transition markets are notoriously slow to price in. This story isn't finished. It's unfolding in capex schedules, export licenses, and factory layouts rather than stock tickers. And when it finally feels obvious, the real decisions will already be behind us, locked into physical assets and long-term contracts. That's usually how systemic change works: invisible first, undeniable later, and impossible to reverse without real cost. Here's the part that really hooks me. Sanctions talk grabs attention, but money already assumes they're permanent. In my view, that gap between words and assumptions drives the entire shift. When China allocates hundreds of billions, it's not reacting to one U.S. administration, it's pricing in decades of friction as the default setting. That's why I don't see this as a trade dispute story. I see it as a trust story, because once trust breaks, efficiency stops being the top priority. Executives across Asian supply chains quietly adjusted forecasts after 2022, not because demand collapsed, but because access suddenly felt negotiable. What's interesting is how little Western markets talk about that psychological change, even though it reshapes capital flows more than tariffs ever did. In my view, the U.S. underestimates how fast systems adapt when they believe rules will only tighten, not loosen, regardless of election cycles. You can hear this indirectly in earnings calls, where companies avoid specifics but emphasize resilience, flexibility, and regionalization. Those words sound harmless, but historically they signal higher costs accepted willingly to reduce single-point failures. This is exactly what happened in energy after Russia sanctions, when Europe paid more simply to avoid dependence again. Semiconductors are following that same emotional logic, not a spreadsheet, and emotions matter more at scale than people admit. The $312 billion number isn't just factories, it's training engineers, securing materials, and locking long-term supplier relationships. Once those relationships form, reversing them becomes politically and financially expensive, even if tensions ease later. That's why I think the real decoupling already happened mentally, even if trade data still shows overlap. Markets usually lag mindset shifts because prices respond to transactions, not intentions. But intentions are what shape 5- and 10-year investment horizons, especially when governments are involved. In my view, this is why chip stocks swing wildly, while infrastructure spending barely reacts, even though infrastructure decides outcomes. You'll notice governments now speak less about globalization and more about trusted partners, a subtle but massive reframing. Trusted means exclusion by default, and exclusion creates parallel systems whether anyone admits it or not. Historically, parallel systems reduce leverage for everyone, including the side that started with more control. That's the irony most headlines miss. Sanctions feel powerful early, but they often accelerate alternatives long-term. This doesn't mean the U.S. loses influence overnight. It means influence becomes more costly to maintain. And when influence gets expensive, institutions start choosing where to apply it very carefully. In my view, chips are where China decided influence risk was unacceptable, regardless of short-term returns. That choice tells you more about the future than any press conference or policy paper. Because systems rarely tell you what they fear, they show it in where they spend quietly. And once you see spending as fear management, the entire story starts to make a lot more sense. Here's another layer most viewers don't consider. Chip spending isn't about tech pride, it's about who gets frozen first when payments, updates, or licenses get delayed. In my view, China watched how fast access disappeared for Russia in 2022 and decided semiconductors were the next pressure point, not a distant risk. That moment changed how planners think. Once you see systems shut off remotely, you stop optimizing for cost and start optimizing for control. The United States still frames chips as a trade tool, but tools become blunt once alternatives exist, even imperfect ones. China's response wasn't loud retaliation, it was silent capex, spread across provinces, suppliers, and universities, which is harder to sanction later. What's interesting is how little of that spending shows up in global trade data because much of it stays domestic by design. In my view, that's intentional. Visibility invites pressure, while quiet buildup limits early interference. We saw something similar with China's power grid investments years ago, long before energy security became a headline topic. Back then, markets ignored it. Later, it became obvious that energy independence changed geopolitical leverage entirely. Chips are different, but the logic is identical. Whoever controls inputs controls the pace of everything downstream. This is why mature node chips matter more than flashy AI processors. Factories don't stop without cutting-edge chips. They stop without reliable ones. Once you frame it that way, the $312 billion looks less speculative and more like insurance premiums paid up front. Insurance always feels expensive until the event it was designed for actually happens. In my view, the U.S. still believes pressure can shape behavior, while China assumes pressure is permanent and plans accordingly. That philosophical difference shapes timelines, patience, and tolerance for inefficiency in a way markets struggle to price. Capital tied to states behaves differently than capital tied to shareholders, especially during long standoffs. This doesn't mean one system is smarter, it means they optimize for different failure modes. And right now, the feared failure mode isn't recession, it's exclusion from critical systems without warning. Historically, when exclusion becomes plausible, parallel structures accelerate whether leaders want them or not. Once built, those structures don't disappear just because relations stabilize temporarily. That's why I think this shift matters, even if sanctions never expand again. The money already assumed they would, and systems rarely undo assumptions once billions are locked in. So the real story isn't escalation. It's commitment, sunk costs, and paths that quietly stop overlapping. When paths diverge far enough, influence turns into negotiation instead of enforcement. And that's the point where the global system starts feeling different, even if no single headline explains why. Here's a layer most people miss. Chip control isn't just technology. It's about who gets frozen first when licenses stall, updates stop, or access suddenly becomes conditional. In my view, China watched how fast Russia lost access in 2022 and concluded semiconductors weren't a future risk, but an active pressure point already forming. Once systems see that access can vanish overnight, cost efficiency stops mattering, and control becomes the dominant variable guiding long-term capital decisions. The United States still frames chips as leverage, but leverage weakens once imperfect alternatives exist and time starts working against pressure. China's answer wasn't retaliation or speeches, it was quiet capex spread across regions, suppliers, and universities, making disruption later far more difficult. What stands out is how little of this spending appears in global trade data because much of it stays domestic by design and avoids early visibility. In my view, that low visibility is intentional because attention invites constraints, while quiet buildup reduces the chance of early interference. We saw this before with China's power grid investments, years before energy security became a headline issue anyone debated publicly. Back then, markets ignored it, but later it became obvious how energy independence reshaped leverage far beyond electricity pricing. Chips follow the same logic. Whoever controls inputs controls timing, reliability, and downstream continuity across entire industrial systems. That's why mature node chips matter more than cutting-edge hype. Because factories don't stop without AI chips, they stop without reliable ones. Seen this way, the $312 billion isn't speculation, it's insurance paid upfront against a scenario policymakers prefer not to name. Insurance always looks inefficient until the moment it becomes the only thing preventing systemic paralysis. In my view, the U.S. still believes pressure shapes behavior, while China assumes pressure is permanent and plans around that assumption. That difference shapes patience, timelines, and tolerance for inefficiency in ways markets struggle to price accurately. Capital tied to states behaves differently than capital tied to quarterly earnings, especially during prolonged geopolitical standoffs. This doesn't mean one system is smarter, it means they optimize for different failure modes under uncertainty. And right now, the feared failure isn't recession, it's exclusion from critical systems without warning or negotiation. Historically, once exclusion becomes plausible, parallel structures accelerate even if leaders publicly deny decoupling. Once built, those structures rarely disappear because sunk costs harden strategic paths over time. That's why this shift matters even if sanctions never expand again in a visible way. The money already assumed they would, and systems rarely reverse assumptions once billions are locked into physical assets. So the real story isn't escalation, it's commitment, sunk costs, and paths that quietly stop overlapping. When paths diverge far enough, influence turns into negotiation instead of enforcement, whether anyone admits it or not. That's the moment the global system starts feeling different, even without a single headline explaining why. What happens next won't look dramatic at first. In my view, the future phase is quieter, where systems adapt so gradually that people mistake it for stability. China doesn't need to win the chip race to change outcomes. It only needs to reduce vulnerability enough that pressure stops producing predictable results. Once that happens, sanctions lose their sharp edge and become negotiation tools rather than enforcement mechanisms with guaranteed impact. The United States still holds enormous leverage, but leverage works best when the other side has no time buffer. What this shift suggests is that time itself is becoming the most valuable strategic asset, more important than efficiency or cost leadership. Markets often ignore time because it doesn't trade well on screens, but institutions plan around it obsessively. Over the next few years, I expect more parallel systems to exist quietly, even as trade numbers still show interdependence. That coexistence will confuse analysts because surface data will say cooperation while infrastructure says caution. We've seen this before in energy markets, where trade continued even as trust never fully returned. Chips may follow that same pattern, with supply flowing, but assumptions permanently changed underneath. In my view, the biggest future impact won't be price spikes, but slower innovation diffusion across borders. When systems fragment, ideas travel slower, even if goods still move. That slowdown doesn't feel like crisis, but it compounds over time into strategic divergence. Companies caught in the middle will face higher costs, more compliance layers, and harder capital decisions. We're already hearing this in earnings calls, where firms talk about resilience instead of expansion. That language usually appears when growth becomes conditional rather than assumed. For China, the future payoff isn't dominance, it's predictability under stress. For the U.S., the challenge will be maintaining influence without accelerating alternatives too quickly. Historically, dominant systems struggle most when tools that worked before still function, but less reliably each time. That uncertainty forces more frequent use of pressure, which paradoxically speeds up hedging behavior. In my view, this creates a feedback loop where every action slowly reduces its own effectiveness. None of this points to collapse or resolution. It points to a longer period of managed friction. Managed friction feels stable until a shock exposes how different the underlying structures have become. When that happens, people often say the change came out of nowhere. But in reality, it was paid for years earlier, line by line, in budgets no one watched closely. That's why the $312 billion shift matters far beyond chips or China. It's a signal that systems are pricing a world where access is never guaranteed again. And once systems accept that premise, they don't go back. They build buffers, alternatives, and patience into everything they do. By the time the future feels different to everyday observers, the architecture will already be locked in. That's usually how systemic change ends up looking obvious only in hindsight. Not loud, not sudden, but quietly irreversible once enough money commits to the same assumption.